Managing the risks of short selling. Short selling is a strategy where an investor borrows a stock and sells it, hoping the price will decline. If the price does fall, they buy the stock back at the lower price, return it to the lender, and profit from the difference. However, short selling carries significant risks. Risks of short selling, unlimited loss potential. While a stock's price can theoretically rise infinitely, an investor's profit is limited to the difference between the initial selling price and zero. This means a short seller can face substantial losses if the stock price increases. Time constraint. Short selling is often a short-term strategy. This means the investor needs to close their position quickly. However, market conditions might not be favorable, forcing them to buy back the stock at a higher price to limit losses. Margin calls. Short sellers are required to deposit collateral with their broker. If the stock price rises, the investor's collateral decreases, and the broker may issue a margin call, demanding more funds. Failure to meet the margin call can lead to the broker closing the position, resulting in a loss for the investor. Market conditions. Short selling can be negatively impacted by market conditions. For example, positive news about a company or a general market uptrend can cause losses for short sellers. Risk management strategies. Stop-loss orders. A stop-loss order automatically closes the position when the stock price reaches a predetermined level. This helps limit the investor's potential losses. Target price. Before shorting a stock, investors should set a target price. When the stock reaches this price, the position should be closed to realize profits. Margin management. Investors should closely monitor their margin and ensure they have sufficient funds to avoid margin calls. Market monitoring. Investors should closely monitor the market and be prepared to adjust their positions quickly in response to negative news or developments. Diversification. Diversifying the portfolio can reduce the risk of short selling. Instead of focusing on a single stock, investors should hold stocks from various sectors and companies of different sizes. Education and experience. Short selling is a strategy best suited for experienced investors. Before shorting a stock, investors should have sufficient knowledge and experience in this area. Conclusion. Short selling is a high-risk, high-reward investment strategy. To manage its risks, investors should carefully implement the methods mentioned above. Before shorting a stock, investors should consider their risk tolerance and financial situation. Warning: investing in the stock market is risky. Be sure to do your own research and consult with a financial advisor before investing. This information is not intended as investment advice. The author and publisher are not responsible for any losses incurred.